Today I will tell you in detail about the structure of my portfolio. I will try to explain the essence as thoroughly as possible. I remind you that very soon I will start managing a portfolio from scratch, absolutely from scratch. And now I will tell you in detail how I will buy stocks, how I will form the portfolio, and what it will consist of. I will explain why I chose these criteria for selecting stocks, how many stocks should be in my portfolio, what tools I will use. Let's start from the very beginning, with the rule of portfolio management. We'll start with the goal. The most important thing is to define the goal before investing. You must understand and set your goals. Until you define the investment goal, you might as well not start investing, because it's one thing to save for retirement, another to buy a nice house, and yet another to leave stocks as an inheritance. I don't know your goals, you must define them for yourself. Let's see what goals I will have for this portfolio. The first goal is to outperform the S&P 500 index. Yes, my main goal is not to save for a house or retirement, but specifically to outperform the S&P 500 index. This will involve a completely different style of investing compared to, for example, saving for a house. Many things will be different, including strategies. The second goal is to earn $1 million. Again, this is more of a symbolic goal because I want to show that with smart portfolio management, using mathematics, especially mathematical expectations and exact sciences, you can gradually, steadily earn this money. Yes, it can't be done in 1 or 2 years, but steadily working towards this goal. I will show you everything that will happen. These are my goals, the goals of my portfolio, and that's the most important thing. I've added these images here to show you how I envision my portfolio. The blue line is the S&P 500 index, and the yellow line is how I will try to outperform the S&P 500 index. I'll start with a disclaimer: this is by no means advice. It's not an investment guide, it's solely my vision of how to construct a portfolio. I don't recommend you follow it because you should tailor your portfolio to your own life goals. I'm simply showing you how I will do it, so this is purely informational for acquainting yourself with my approach. Now, on to what I will use. Firstly, my portfolio will consist of quality stocks, and I will also use options. I will use options for hedging and for generating additional profits. So essentially, my portfolio will comprise stocks that I will buy and hold for the long term, and additionally, I'll use options to earn extra money. As for futures, I will use them very rarely, perhaps even never, because futures are primarily a tool for traders. If there's a situation where I need to hedge very quickly, for example, the S&P 500 index, and options are too expensive due to volatility, I may use futures. However, this would be more speculative, and I prefer a more measured approach. So I will try not to use futures. Let's look at how I will structure the portfolio. Firstly, my portfolio will include 10 high-quality stocks and also the S&P 500 index. The 10 high-quality stocks will comprise 70% of the portfolio, while the S&P 500 index will make up 30%. Why exactly this allocation? Why 10 stocks and not 20, 30, 50, or 100 stocks? Why not just 2 stocks? I'll answer that many studies have been conducted on the risk-return ratio. If I have too few stocks, say 2 or 3, there's a high chance that those stocks may decline significantly, resulting in substantial losses. If you have more than 10 stocks in your portfolio, then it becomes pointless because, for instance, if you have 100 stocks, each stock represents less than 1%. Congratulations, you bought Nvidia, it surged by 700 to 1,000%, and you look, but your portfolio hardly felt the movement because the more stocks you have, the more meaningless it all becomes. This is not just my opinion. Again, I'm basing this on mathematics. At the end of the presentation, I'll provide you with links to articles and information so you can understand why it's necessary to use this specific number of stocks. Yes, maybe 15 stocks or 13 stocks is acceptable, but 20 to 30 is already pointless. For example, having only 5 stocks is too risky. To stabilize, I will personally buy the S&P 500 index. This is also included in my mathematical calculations. I will build my portfolio based on mathematics, and I remind you of my goal to outperform the S&P 500 index. Therefore, it must be present in my portfolio. If I exclude it, there won't be stability, which is very bad. If my goal, for example, were to outperform Tesla stocks, then undoubtedly I would have to include 30% of Tesla stocks. If my goal were to outperform stocks in the Nvidia, then I would include 30% of Nvidia. I hope you understand my logic. It's purely mathematical calculation. The calculation will be based on the SP index moving together with mine, and the stocks in the SP 500 index will outperform it. Just as I will buy stocks, they will all have equal weight. I mean, I'll have only 10 companies. I'll definitely show which specific ones I bought. Everything will be transparent, and I'll analyze each one. There won't be a situation where one stock occupies 10% of the portfolio, another 2%, 3%, 5%, everything will be balanced. All stocks will have equal shares in the portfolio. This is also based, once again, not on my opinion, but on mathematical analysis. There have been many studies and experiments, and I'll leave the information for you at the end of the presentation so you can read if you're interested. Let me give you another example. Suppose you bought stocks in Nvidia for just 1%, and some other stocks occupy 20% of your portfolio. Nvidia stock surged, and you practically earned nothing. Let's assume you bought 20% of Nvidia stocks. Then, of course, your portfolio would have grown significantly. But I'll tell you it's not possible. I deny the fact that predicting stock movements is impossible. That's why equal-weighted stocks. I don't know which stock will be more expensive or which will grow more. If I did, I'd just put all my money into that one stock. Similarly, if you can predict price movements, why even bother with portfolio construction? Just invest all your money in the stock that will grow. But since no one knows this, and I'm telling you with 100% certainty that nobody knows this, we must act solely in the mathematical field. We must act in a way that increases the probability in our favor because nobody knows the next Nvidia stock. Absolutely nobody. Therefore, we need to buy evenly to have some effect. And also, if you can predict stocks, then just buy 1 or 2 stocks and make a lot of money. I can't do that, I'm honest about it. That's why I'm creating such a portfolio. The parameters that stocks must possess first, they must be included in the S&P 500 index or in the NASDAQ. In fact, almost all stocks are already filtered out here. It leaves only literally 500 to 600 stocks that I can buy. In fact, this is a very good situation. It filters out all unnecessary, all junk stocks, all stocks that won't fit. In other words, the stocks included in the S&P 500 are already of very high quality. Margin should be more than 20% if we encounter inflation, something else for the company to be able to lose a bit of margin and still remain profitable. Generally, the higher the margin, the more interesting the company, but not all companies I'll be acquiring have such high margins. It's not strict rules. I might deviate from it in sectors like healthcare where margins aren't as high, but I'll delve into that a bit later. Assets should exceed the company's debt. Again, I want to buy a company, not its debt. What's the point of acquiring a company with huge debt when there are companies with no debt at all? I'm not very fond of debts, so that's also an indicator. Furthermore, profit growth per share should be over 15%. It shouldn't be a company just sitting there paying dividends. No, the company should be growing at least 15% per year. Of course, in some years during a recession, perhaps the company might not be able to grow at such rates, but again, it's not a strict rule. It should also pay dividends. Yes, I understand there's a lot of debate about dividends. I know all the arguments people use against dividends, mainly two, they are taxed inefficiently, and secondly, dividends are very low. For example, the dividend index is less than 2%, while inflation is at least 3%, and last year it was even 10%. So all these dividends are useless. I know all these arguments, I understand. But again, delving into research analysis, I've come to the conclusion that dividend stocks surprisingly grow faster than non-dividend stocks. Some may disagree, but that's the information I have. I've analyzed a lot, looked at a lot of charts, and come to this opinion. So dividends are also a guarantee of stock stability. Furthermore, rapid dividend growth is important to me too. If dividends grow very slowly, it's not very good. I'll be focusing, after all, on rapid dividend growth. Again, I'll talk about this a bit later as well, various sectors of the economy. Different sectors of the economy, that's what I'm talking about. There's no point in buying companies in the same sector, for example, Nvidia, AMD, Intel, Micron, because they're all in the tech sector. Of course, tech indices will dominate because it's hard to deny that this sector is developing very well. But you shouldn't forget about other sectors to make the portfolio somewhat balanced. This includes energy, finance, and technology. You'll also see liquidity in the option markets, which is important to me since I'll be using options. And if we invest in options where there's no options liquidity, or it trades, for example, once a month or for just a few days, that won't work. Ideally, options should be traded weekly so that when I have enough shares, I can use a covered call strategy to earn additional profits. And of course, the more options, the better the liquidity, because my strategy will be to manage the portfolio wisely using options. I understand this won't work for everyone, but as I said, this is how I see my portfolio and how I'll form it. Now let's move on to when to sell stocks. I'll sell when a company no longer meets my requirements. Again, there are no specific timeframes. I'll be using long-term investing, and I like the philosophy of buy and hold, meaning you should buy a company for almost your entire life. I agree with that. I won't have any selling deadlines unless the company no longer meets my requirements. For example, Visa stock is good, but if Visa suddenly starts selling burgers instead of focusing on payments, I'll need to sell that stock because it no longer meets my requirements. Do you understand what I'm saying? The same thing Warren Buffett did with airlines during the pandemic. Buffett got rid of his airline stocks, maybe not at the highest prices, and later prices went up. I've seen a lot of negativity towards him for selling almost at the bottom of the market when he could have sold much higher had he waited. I understand the philosophy here is different. He got rid of them because they no longer met his requirements, that's it. So the logic is, if a company no longer meets your requirements, you should sell it, regardless of where it's headed. Even if it's growing very strongly afterward. For example, if Apple stops making phones and switches to cryptocurrency business, and everything in the world is about Apple, if Apple continues to grow, you should sell it at that moment because it no longer meets your criteria. Or if, for example, Apple's stock price drops very significantly after such news, you should also sell those stocks. The price doesn't matter, the stocks no longer meet the criteria. That's the essence of selling stocks. As for how I'll use trading, I've tried to describe all the rules, but I've come to one conclusion: I'll use all the options available, meaning I've tried to describe the rules for strategies like spreads and straddles, but I'll simply use everything, all strategies, all my skills, all my experience. I'll try to apply this through options. Again, I'll show you everything specifically later on. Everything will be detailed. This is the approach I've used. You can check the links, go through them, read the information. Also, any portfolio without risk management is a bad portfolio. I'll definitely take that into account as well. I'll write it all down in Excel, and I'll make a separate video about it. And of course, I'll attach this Excel sheet. Everything will be openly accessible. There will be a separate tab for my transactions, where I'll record all the transactions. You can check it anytime to see which stocks I've bought, which options I've opened, what I've specifically closed. Everything will be transparent. I'll constantly show the account balance with all the money, all the breakdowns. And again, if you have any questions about the portfolio, how I'll manage it, how I'll put it together, write in the comments, and I'll try to answer all the comments. This experiment will start very soon. Good luck to everyone.